And most RIAs, unless they're really big, do not have a board of directors, do not have a leadership structure that knows how to make decisions without the key advisor who's founded the firm or makes all the decisions being there. And that can be big and small. And so the first thing is, who's going to decide what if something happens? And it's at the strategic level, and then even more importantly, or just as importantly, at the departmental level.
Welcome to Rise Up with Rise Growth Partners, the podcast created to inspire wealth advisors and elevate firms, one transformative idea at a time. Joe Duran and the Rise team share hard-won lessons from building top wealth management firms, showing you what it takes to create a lighthouse brand that inspires clients, attracts talent, and fuels growth. Together, we'll look at where the industry is headed so you can stay ahead of the curve. We're here to be the coach we wish we had along our journey. Let's dive in.
Today.
It's great to be here, Jen.
So today the topic is how to prepare in advance of a catastrophe. You know, the California wildfires, not far from you at all, have gotten all of us thinking about, are we really prepared? Are we prepared personally? Are we prepared professionally? So I thought we would start by, you reflecting on what's happening now near you and
Sure.
and any experiences you've had that were unexpected that opened your eyes to the importance of preparing in advance.
Well, Jen, obviously, I've got a lot of good friends. Our first business we built in Los Angeles. My wife's fourth generation West LA girl. Countless friends who've lost their homes. Some of them have a home standing and everything in their neighborhood is a wasteland. So that's in the Palisades. I know fewer people in the Pasadena and Altadena area, but it's still calamitous. And interestingly, the reason I wrote this article for CityWire is that we are least prepared when things are best in our lives. And this is a collection of people, at least in the Palisades, who are at the top of their professional game, who are well prepared. And through a series of unfortunate events in the last few years, we've had a lot of fires here in Southern California. And we're very prepared for earthquakes, although knock on wood, we haven't had one for a long time. We've all been through the drills. We know what we would do. But in an earthquake, if your home drops, you can still sift through the rubble to pick up what you need. In a fire, everything gets destroyed. And we as humans are very well geared towards things that we've experienced recently. We never think of a calamitous outcome where our whole life is turned upside down. We don't think of what happens if somebody gets into a car accident or gets into a car crash or something external affects us that literally wipes us out. And unfortunately, in this situation, most people have been dropped in insurance. My own home has no traditional insurance because the insurance companies refuse to actually provide it at any price. And California has restrictions that it doesn't allow them to charge what they need to charge. And so the only thing left was a California Fair Plan with definitely not enough money to provide capital for the billions and billions. I think we're up to $250 billion, the last estimate of damage. And the California Fair Plan, I think, has a couple $100 million in it, which is not even close to the value of these homes. So we're maxed at $3.5 million, which seems like a lot of money for structural repair, except that these are homes that are worth $6 or $7 million, 5,000, 6,000 square feet. And that creates a huge problem. For the people in Altadena, these are not super wealthy people. They're homes that maybe are 300, 400, 500,000, but they didn't even have any insurance, not even California Fair Plan. And their lives are completely turned upside down as well. And so we're going to do a separate thing about how to prepare clients. I want to talk about the impact on a business because, again, I've experienced 2 near-death experiences in 2 businesses I've built. And they were life-changing for me. I grew up in Zimbabwe, so I'm naturally geared toward catastrophic events outside of my control. But what
I worked, Joe, with 2 firms that sadly had the founder / CEO passed completely unexpectedly at a young age. And it's devastating for the people. And at the same time, you really want to make sure the firm and the clients are taken care of.
And so, the thing that you have to do in any of these situations is it doesn't make it any better. It doesn't feel any better if you're not
Mhm.
prepared. But if you've at least gone through a contingency plan, which is a requirement, by the way, by the SEC,
Yes.
that you actually go beyond what the SEC requires so that people are not left in complete chaos to deal with the aftermath.
Yeah.
And
I think a lot of firms put something on paper to satisfy that requirement. It doesn't mean it's a sound plan.
and it also that people know what they're meant to do. And so
Yes.
I created something because of two situations that happened in my past life. I'll just share with you. My
Mhm.
first business, which is now called AssetMark, but it was called Centurion Capital when we were building it, we had an operational crisis that happened around 1997, something like that, 98. And we ended up losing half of our clients in about 4 months.
Wow.
And we were simply not prepared for it, not in a financial sense, not in an operating sense. I was young, I was 28 years old, didn't know what I was doing, but we had a couple $1 billion, which at the time was a pretty large RIA. And we had to pivot. We reinvented the business. We were bigger at the end of 18 months, but it was one of the hardest periods of my life, an incredibly humbling event. And then during building United Capital, we had the financial crisis where basically the whole world stopped. We had
Mhm.
all kinds of, we had the Fed fund breaking $1. Like we just had all kinds of calamitous events, all kinds of fixed income vehicles that had no liquidity, and being prepared for that. And so as a consequence of that, I created what I called the A list, which is a way of in advance, the things that you better have right if you want to get through to the other side and at least have people not be in complete chaos. Because again,
Mhm.
it's always going to be awful and there's nothing we can do to change that. But being thoughtful and in advance when you're not in the heat of battle, knowing who needs to do what is really important.
So let's go through it. Let's go through the A list. So the first
So,
letter,
first
the
of all,
A.
A list is an acronym. So
Yes.
A stands for accountability. As we know, most RIAs are run by one or two founders.
Mhm.
They are the people who make every single decision for the business. And if that person's not there, nobody even knows where to go. Now,
Mhm.
this is not only bad business practices because it says that you're basically limiting your ability to grow because you have a bottleneck at the top of the bottle, but it creates a truly calamitous situation if anything goes
Mhm.
wrong. And there are two levels of accountability. First, are big strategic decisions. And most RIAs, unless they're really big, do not have a board of directors, do not have a leadership structure that knows how to make decisions without the key advisor who's founded the firm or makes all the decisions being there. And that can be big and small. And so the first thing is who's going to decide what if something happens? And it's at the strategic level, and then even more importantly, or just as importantly, at the departmental level. Because this is equally true if you
Right.
have a CIO who makes all the investment decisions and something happens to that person, or your trading platform stops working. Like, what do you do for
Mhm.
accountability? Who's responsible for addressing issues? And this, by the way, is true for individuals, but we're going to focus again today on if you're running a
Mhm.
business, having real accountability of what happens for every major decision. And you should think about financial decisions, you should think about operating decisions, and you should think about departmental decisions. And so taking the time to waterfall and create a checklist for who makes what decisions to
Mhm.
step in. Just like you have a trustee if somebody has a problem, you need to think about in the event that something happens that we're frozen and can't access the person who typically makes decisions for the business or for certain departments, what then? And
Mhm.
it's easy, again, if it's the CIO, you still have the CEO, but what happens if they're both on the plane together and something
Right.
bad happens? So again, none of us want to talk about our demise, but we've got to be
Right.
practical about the fact that we have responsibilities to our clients and to all of our employees as well and our shareholders. So having a documented and structured decision-making framework as to who's accountable, really important. It's like a living will. Like who
Yeah.
does what if I'm incapacitated? So that would be the first step. So
And
that
then
there's a
the L is for liquidity.
liquidity. It's interesting. as we've been in this incredible runaway market, what I have seen is less and less dependence on working capital, less and less cash on the balance sheet. There is no way to make a crisis worse than not having enough readily available cash that requires no sale of any assets and allows you to get money. Even with working capital lines that you might have with a bank, there might be conditions on those lines that if the CEO is not able to be available, or if there's a material adverse change to the business, the bank doesn't have to actually fund your working capital line. So taking the time to say, how much cash do we have and for how long do we survive, especially if you're billing in arrears or in advance. And now it's a great business because we don't have inventory. We don't have the traditional things that most businesses have, but you do have payroll. You do have people that need to be there in order to do their jobs. And so thinking about those two things, what's our cash runway if something goes sideways? What's our safety net? And don't distribute all of it. Because again, a lot of firms are run as lifestyle businesses. We give out massive distributions. And so you need to have a cushion there, A. And then B, what happens? What are the conditions on our bank line so that if something goes AWOL, because again, why people can do big distributions, the banks are very comfortable lending money, which is a new thing in our industry. But again, it's not a risk until it's a risk. And then all of a sudden you go, oh my God, they don't need to fund us because there's this material adverse change clause on the credit line. And that can put you in a position where you can't make payroll, staff doesn't show up, nobody knows what happens. And so you've got to be in a condition. And this is really important for an adverse market condition where out of nowhere, the market loses 50%, which none of us expect, none of us want to happen, but something could happen.
But it could happen.
That paralyzes you at the worst possible time, and you don't have the cash on your balance sheet, and it's at the end of the quarter, and you can't get a bank line because they say it's a material adverse change. And all of a sudden, you're firing people. You're not able to do the work that's necessary, and it creates chaos. So having more liquidity than less gives you a lot of optionality if things don't work the way you want.
Yeah. And Joe, what you're talking about also relates to your next letter in the acronym, indebtedness. A lot of firms are leveraging their businesses, maybe over leveraging. How should they think about the trade-off between leveraging for growth and protecting themselves as well?
Look, if I had to say there's one area that's the biggest risk to any RA that I see, it's these lines that people are taking on very often with personal guarantees. Again, it's all fine until it's not fine. And if you are taking personal guarantees out to fund the business when it's not necessary, and these are the things, again, we all are geared toward growth and investing in our growth. And that every time you invest for growth, you're taking away your ability to survive a crisis. So there's this delicate trade-off you have to think about, which is how much risk should I be taking? What are the implications? And what happens if the worst imaginable thing were to happen? You have a personal guarantee, you get incapacitated for whatever reason, your family is now liable for this personal guarantee. Your biggest asset is the business, and that asset, without your presence, is suddenly worth a lot less if you can't, for whatever reason, correct it. Even a buy-sell agreement that you might have with your partner might not work the way you would like because there's conditions in there that allow for the business to go in the wrong direction, and all of a sudden this pile of debt becomes a huge problem. So there's known indebtedness, the things that you know and assume, and then there's what I call off-balance sheet liabilities, and you have to include those too. Promises made about bonuses, about equity commitments, and firms are way too lax about documenting, here are the things that we are responsible for that we haven't yet documented. So you've got an employee who was expecting to get a big bonus. They were told they were going to get a big bonus. All of a sudden, you're not able to confirm that they are meant to get that bonus. That employee now goes, excuse me, I was told I'd get this. Or they weren't told that and they just tell you that was the case.
Or they just got the bonus every year and it becomes, they ratchet up their lifestyle and it's an expectation.
And so there are all of these off-balance sheet liabilities. It could also be a financial commitment that you made that you don't account for in your balance sheet. So again, larger firms are very accustomed to putting those liabilities in an account, but smaller firms, even firms that have billions of dollars in assets and tens of millions in revenue often have these casual conversations with commitments made that are expected to be honored unless the person who's making those commitments hasn't told anyone about them. And so having a documented, here's our liabilities, here's what happens if things don't work the way we hope and we get a crisis, and how do we overcome that? And here are all the liabilities that we can think of, commitments made that we need to have in the ready should something happening. So again, really important as you think about it, that we map out scenarios that aren't as optimistic, especially when we're taking on liability. Because debt, again, we've become very glib as individuals, as a country, and now businesses are operating under very similar, very rosy, market's just going to go up 10% a year.
Right.
And this is one where you don't need a huge crisis for things to go really upside down for you if you have the wrong kind of debt and too much of it.
Okay. So moving on, the next one is S for simplicity. We have a tendency in our industry sometimes to make things overly complicated. How do you think about the advantages of keeping things clear and simple?
I have to tell you, this is a pet peeve of mine. You just have to remember, complexity reduces value. Just remember that expression, because it's true. Complexity in operating structure, complexity in serving clients. Now, of course, what we've now gone is RIAs, in order to be competitive with their colleagues, keep adding more and more services. I'm going to do tax prep. I'm going to add a broker dealer. I'm going to get into alts. And they all might give you a slight edge and competitive advantage. But it adds so much complexity, it's actually a bad business decision because you're not going to do everything great. And it's different to be a facilitator who consolidates these solutions than the provider of these services. I can't tell you, as you know, we speak to dozens of multi-billion-dollar firms. And this is the one thing that they'll say, well, we're adding tax prep and we're adding corporate executive services and we're adding XYZ and XYZ. And I'm like, look, you can't do it all well. And again, you can provide those solutions without doing it. But the more complexity you add from alternative products, again, I'm a big fan of all of these solutions. But whether you're doing them in-house or outsourcing, the potential of it going wrong and the thing that you added as an ancillary service actually creating the crisis for you. Like you decide to get into tax returns and something goes wrong and you get a Privacy Act violation and all of a sudden it collapses your entire business because it's not the thing you do really well. Or you have an alts product that you've created in specialty real estate and fire hits it and all your clients are invested in it. It's something you created and now you've in a fiduciary battle with your own clients and with the SEC unnecessarily. And so again, we tend to be very desirous of solving every problem ourselves. Every time you do that, you're adding complexity, you're making the transition, or if there is a crisis, the possibility higher that there'll be a crisis from those very areas. And if there isn't, and another crisis hits, the possibility of navigating your way through because of the hornet's nest of complexity in a structure that is not necessary. It doesn't incrementally make you better. It doesn't allow you to get better.
Right. It doesn't even mean you're providing the best solution as a fiduciary.
Exactly.
How can two people at a firm focused on one area do a superior job to a whole business focused on one area?
And so you're just adding that complexity. So asking yourself the question, what happens if this doesn't work? What's the potential of it really hurting us? And then if we decide to do it anyway, what happens if something happens to the decision makers? How do we make sure that this continues to happen? And again, this is a bull market scenario because, again, after 2008, lots of people were like, I'm never doing that again. After the real estate crisis in the 90s with REITs and the tax shelters, everyone said, we're not doing that again. And we're now in a sloppy period. I consider it a sloppy period where people who are great at servicing clients have now decided that they want to do everything for the clients rather than realizing clients want solutions to be provided.
Everyone's a family office.
Yeah, exactly. Paying bills and doing things that add such layers of complexity. And you just have more possibilities of things going wrong rather than concentrating your efforts on the things you're really great at. And they're not spending 5 minutes on the things that actually help them to survive a crisis. And that's being great at one thing. So again, this is more of a longer term conversation. We'll do it at a different time because it's a topic I care deeply about. But you just need to know that complexity reduces value and increases risk. So every time you're getting into a new business line, adding new products, you've got to ask yourself, what happens if something goes wrong in this thing, or something goes wrong with one of us that doesn't allow for us the continuation of that service?
Makes sense. Okay, the last T. T is transparency. Tell
I think
us
maybe this is an area again that we don't often enough do exactly what we tell our clients to do, which is have a consolidated view of your whole world and have an updated, ongoing view of your whole world. Information is not shared openly in a lot of firms. It'll be just the CEO and maybe one or two of their executives who know everything. If something happens, there's suddenly no visibility as to how things work. It's one of the disciplines that we bring to all of our firms is, hey, visibility and transparency and decision making. You don't have to have everyone know what the balance sheet looks like, but they need to know how to access it. You need to have whoever's accountable able to go to one location that is cloud-based, that allows them to see, here's a checklist of all the things we have and where they are and how to reach them, so that you know this is how we do payroll. Having protocols for everybody so that you have transparency and visibility of where to go when things go sideways. Because again, without it, you're just in the dark. And it's one of our, as advisors, the biggest value we provide to clients. If something happens, we typically know where everything is.
We tell them have backup to your backup, know where everything is, have multiple people know how to access things. But do we do it as a business?
And again, just think about it. There are wealth advisors in the Palisades who had their offices burnt down and everything, no location, no nothing. What now? Now, again, the more complicated the business, the harder. The less liquidity, the harder. The more debt they have, the more difficult it's going to be. The less transparency they have, the worse it is. And the less accountability you have, the harder it is. So again, having a complete view of the A-list, making sure that you have thought seriously about a calamitous event or a crisis and how to not make it be the end of your business and continue to live up to your responsibilities. Again, I wish it on no one, but actually thinking about it actually lets you to run a better business, one that gives you less sleepless nights, one that's less dependent on any one key executive in order to make it to the other side. So again, maybe it's because I grew up in Zimbabwe and always expecting the next shoe to drop.
Yes.
But it's one of the reasons no business I've ever built has my name on it. It's one of the reasons we have people like you, Jennifer, senior executives who know how to operate. And I've always been very, very careful with debt. Even when we were building United Capital, it was always, look, we're not going to be more than 2.5 to 3 times because I know what happens if things don't work. Because I was there in 2008 and saw businesses that collapsed that were really on a great track and they just couldn't withstand the market decline, what happened with the ability to keep refinancing their debt. Unfortunately, we weren't there. We were equity financed in the beginning. And again, it doesn't matter till it matters. But when it matters, it's life or death.
Yes.
And so again, being thoughtful about that,
Joe,
and hopefully no one ever has to worry about this.
Yes.
But thinking carefully about that.
If a leader is watching today and feeling like maybe they've done a little bit of this, but they're feeling a little uncomfortable, what's one tip you would share with them to move forward and protect themselves and their business?
I think you could literally take my A-list that we created and sit down and say, which of these, on a scale of 1 to 10, this is the easiest thing you can do, which is our biggest risk? Like literally go each one and say, on a scale of 1 to 10, how am I doing on this thing? Either rank 1 to 10 the risk or 1 to 10 how well you've done it. Doesn't really matter, but use a ranking system so that you can identify the things that are of highest risk. Hey, we've got a lot of debt, or I've got personal guarantees on this stuff, and I don't really know what the conditions are, because there's some stuff that's really low-hanging fruit that you can clean up right away that are high risk, that you can right now say, hey, I better just go read the terms of the loan of my bank line. Or this quarter, I'm going to not distribute as much for the next year to build up a cash reserve. Because again, Just being
Or
prepared.
bring my leadership team into these discussions.
Or have a checklist for what happens if something happens. So go through the A list and say, where are we deficient? Rank yourself on a 1 to 10 as this is where we're doing great. But I like the deficiencies. So,
Yes.
where you have problems, go to the high numbers. Hey, we are a 2 or a 3. We've got to fix this, and we need to get it to an 8. Like, where are you gapped? And again, nothing's going to be a 10 because you're a growth investor. You're not a bank.
Right.
But thinking carefully about where are our risks, being comprehensive in it, and just take the time literally to sit with your executive team or your partners and say, hey, let's just go through this and take 30 minutes, an hour to just go through how we think we're doing in these key areas. You do that one thing, you'll at least have it in the front of your mind. You'll then have a set of work processes you can follow. It makes you into a better business, makes you into a more secure business. It will actually bring comfort to your spouse and your partners. So
Yes.
Again, none of us like spending time on that bad thing, but it's important that you do.
Absolutely. Well, thank you for sharing the A list with us, Joe. And next time, as you said, we'll talk about how advisors can really partner with clients to make sure they're prepared as well.
Thank you, Jen. And hopefully no one ever needs to use the A list. So
thank you. Thanks
have a
for
great
joining
day.
us.
You are listening to Rise Up with Rise Growth Partners. If we helped you to rise up today, please subscribe to the show so you don't miss future episodes. Leave us a review to tell us what you loved, what topics you'd like to hear, and please share it with others in the industry. After all, we're here to rise up together.